very good morning to you and welcome to this day of the Rwanda Monetary Policy Committee and also Financial Stability Committee, where we do have the governor speaking right now on what to expect. Let us listen in.
1.8% in 2024 to 1.4% in 2025. And if we look in our region, Sub-Saharan Africa is forecasted to maintain relatively strong growth, with the region expected to experience a slight decline for a GDP growth of 4.0% in 2024 to 3.8% in 2025, and then accelerate again to 4.2% in 2026. Now turning to global inflation trends. While inflation is projected to continue to decline, the pace of disinflation has slowed, and this is largely due to continued uncertainties in trade policies. And global inflation is projected to decline gradually from the 5.7% we had in 2024 to 4.3% in 2025, and further down to 3.6% in 2026 because of commodity prices that are projected to continue to fall. As you see, the global energy index is projected to decline by 17.4% in 2025, while non-energy index is projected to also decline by 3.3% in 2025. And I was talking about international commodity prices that will see a decline, and we observe these significant developments, and mainly due to persistent drops in crude oil prices, which are projected to fall by 20.7% in 2025, and natural gas is projected to rise by 5.8% before falling again by 8.6% in 2026. Now turning to Rwanda's external sector. The trade deficit has widened in the first 3 months of 2025, and we observe that merchandise export declined by 3%, mainly due to weaker regional demand for re-exports. However, traditional exports such as coffee, tea, minerals grew by 8.7%, and this performance was supported by stable domestic production and elevated international prices. Non-traditional exports, on the other hand, mainly manufactured and agricultural products, also saw a strong increase of 10.1%, reflecting solid performance from our domestic industries and steady foreign demand. On the import side, we see that imports rose by 5.8% in the first quarter of 2025, and this was driven by higher imports of raw materials to support our local industries, as well as capital goods, particularly machinery, electronics, and transport materials. Looking ahead, the trade deficit is expected to expand in 2025 and 2026, largely due to large-scale projects, including the Bugesera Airport. But this will be partially offset by a strong service exports like tourism and air transport, as well as steady remittances. And as a result, we are confident that international reserves will remain adequate, covering more than 4.5 months of prospective imports of goods and services. Now turning to Rwanda's domestic economy. We all recall that we had a strong performance in 2024 with real GDP growth reaching 8.9%, up from 8.2% that we had in 2023. And we see that trend continuing when we look at our high-frequency indicators, with the composite index of economic activities growing by 9.3% in the first 3 months of 2025 compared to 8.5% that we had in the same period in 2024. And this reflects strong activity in trade, transport, hospitality, financial services, and telecommunication. Growth was also supported by ongoing construction, higher industrial production, and increased mineral exports, while agriculture has faced challenges due to adverse weather conditions and is expected to post moderate performance in the near term. But overall, we expect the economy to sustain its momentum in 2025 with projected growth of 7.1%. Turning to the monetary sector, we've observed significant easing. The interbank rate has declined by 151 basis points from 8.29% in the first 3 months of 2024 to currently 6.78%. And this follows the 2 central bank rates cuts that we had in 2024 of a total of 100 basis points, but also it's a result of ample liquidity that we have in the banking system. The deposit rate, it's also declining. It has declined by 84 basis points to 9.45%. And the most notable drops were in terms of deposits across various maturities. Lending rates on average also falling by 46% to 15.89%. And this was mainly driven by a significant decline in short-term lending rates, but also noting that short-term loans now account for 59% of all new authorized loans. We will now go to inflation developments. In the first quarter of 2025, headline inflation increased by 6.7% year on year. And the last quarter of 2024, we had an inflation at 5.2%. And this increase that we see was mainly due to higher core and fresh food inflation, while energy inflation eased. You can see that core inflation, there was an uptick in prices related to hotels and restaurants, which offset declines in housing and transport. Energy inflation eased thanks to lower solid fuel prices, and here solid fuel means firewood and charcoal, despite a slight increase in liquid fuels, petrol and diesel, following a revision in pump prices in February this year. And in April 2025, headline inflation stood at 6.3% due to lower core inflation, even as food and energy prices rose. And fresh food inflation particularly increased due to lower market supplies of beans and Irish potatoes, which are still in their growing season under Season B. But overall, we can see that the inflation in Q1 2025 still remains within our target band between 2% and 8%. Therefore, we go to the inflation outlook in line with expectations. Headline inflation has remained within the target range during the first quarter of 2025, and despite some upward pressure from food and core inflation. And looking forward, our inflation is projected to stay around 6.5% for the rest of the year and expected to decline to 3.9% in 2026. Nonetheless, risks to this outlook remain, and these include rising trade uncertainty and geopolitical tensions. And so, taking all that in consideration, the Monetary Policy Committee has decided to maintain the central bank rate at 6.5%. And this is a level that we consider adequate to keep inflation within the target while continuing to support economic activity. We are now moving to the financial sector performance for the first quarter of 2025. And as you can see, economic momentum supported the financial sector's growth. Total financial sector assets increased significantly by 23.2% and reached 13.6 trillion at the end of March 2025. And that growth is across all subsectors. The banking sector's assets grew by 23.3% on the back of increase in deposits, largely coming from corporations and institutional investors. The microfinancial sector as well saw its assets growing by 20.6%, supported by a growth in both deposits and growth in equity. In the insurance sector, grew by 18.1%, driven by increase in investment income, but also in premiums and equity. And the pension sector as well recorded a 23% increase in total assets. We can see that the financial sector continues to play an increased role in the economy. And as it grows, its contribution to the broader economy is highlighted or emphasized by, one, the share of total financial sector assets to GDP that has now reached 70.3%, compared to 64% that we had in the same period last year, while the credit to GDP has now reached 27%, compared to 26% in March 2024, and this reflects the sector's growing role in financing the economy. We see it in the next slide, where lending institutions have continued to lend. In the first quarter of 2025, new authorized loans in banks reached 643 billion Rwandan franc, an increase of 29% year on year, while outstanding loans stand at 5.2 trillion Rwandan franc, which is an increase of 13%, and these are outstanding loans from both banks and the microfinance sector. And in line with the new authorized loans, we've seen that the total loans grew by 13%, and here I wanted to also break down that the largest shares of new loans went to the trade sector at 27.9%, then households, real estate, construction, and manufacturing. Now looking at the banking sector specifically and its stability indicators, the banking sector remains well capitalized and stable. The capital adequacy ratio for the first 3 months of 2025 stood at 22%, and this is well above the 15% minimum regulatory requirement. And on the liquidity side, the liquidity is also robust, with a liquidity coverage ratio at 337%, and this strong position reflects increased deposits in the banking sector. On asset quality, banks continue to mitigate risk linked to their loans, with a non-performing loan ratio that has continued to improve, reaching 2.7%, which is well below the 5% threshold. The banking sector continues to also be profitable. The return on equity continued to be high, standing at 19%. By end March 2025, while return on assets rose to 4.8%, supported by a rise in income-generating assets, as well as improved operational efficiency. Going to the microfinance sector, it also continues to hold enough capital and liquidity, with capital adequacy ratio for the microfinance institutions at 35.5%, above the minimum required. And liquidity also has improved, with a liquidity ratio of 68% compared to the 30% minimum requirement. On the non-performing loans, NPL in the microfinance sector is also at 4.3%, which is below the maximum threshold of 5%. Private insurers have also maintained their ability to manage risk and also meet clients' demands. Their solvency stood at 199%, well above the 100%.